Good morning, everybody, and welcome to this Q1 presentation of the Hafnia results, which came out this morning. My name is Ture Østergaard. I'm with HCA, and I will be the host and moderator today. Welcome to you, Michael Skov, the CEO. I understand you're in Singapore today.
Correct. Yeah, absolutely.
Perfect. Welcome to this event. We will do approximately 25 minutes. We'll cover the Q1, including the dividend. We'll cover the US stock listing, which has happened in Q1. And then, of course, we'll go into the order book and the fundamentals of the industry. So welcome, everybody. But perhaps, Michael, over to you, and perhaps just this brief introduction we always start with in Hafnia.
Yes, thank you for that. So for those that are not too familiar with Hafnia, so we are a shipping company that's involved in the transportation of refined oil products. We're the world's largest global operator of product tankers that are transporting these refined oil products. It's a company that's been very active over the course of the last 10 years in building the business to where we are today. And that's a lot to do with what we, on the top left side here, calls active management, which basically indicates that we have been growing without taking unnecessary risk, but with the focus of trying to expand at the lower point of a cycle and harvest on the higher point of the cycle, which is where we are now. So it's been an interesting journey for Hafnia to get us where we are today. We own, financially control 130 of these product tankers, but we operate above 200 ships overall, which is due to the fact we operate other owners' vessels on a commercial basis. We have an asset value of $4.3 billion. And as Ture just mentioned, we're listed actually in two places. We have a dual listing. We're listed in Oslo and we're listed in New York, but we'll get back to that a bit later. So scale for us is an important part. It's important to know that Hafnia is one platform only, which means that all the fees generating that we have from various business sources all comes into the same platform. So we don't have any split out of revenue or profits at all. It all flows into the same platform, and it all flows out again to all the shareholders on an equal basis. A strong focus so far on increasing shareholder value. As I said earlier, we've been through a growth period, and now it's in a harvesting period. So investing in Hafnia has meant that there's a lot of dividend that has come and will continue to flow. So that's kind of the overall strategy at the moment, is to return capital to shareholders after having spent money growing the company in the last few years.
Thank you for that brief introduction. And just to supplement you, actually the market value now is around the NAV, $4.2 billion US dollars, or 46 billion Oslo kroner. Sorry. But let's go into the Q1, Michael, and see how it has been.
Yeah, so we came out with the result this morning, and Q1 was a net profit of 219.6 million. I should say that's before an adjustment of IFRS, which is a technical adjustment that we've now introduced, mainly due to our listing in the US. So if you want to compare to other quarters, you have to add 7 million. So approximately 227 if we compare to previous quarters on the net profit. So it's our second highest quarter, and obviously reflects that we've had a strong start of this year. What's interesting also is that we have now changed our dividend policy, so we've announced that we're paying 80% dividend, and that's consistent with our net loan to value ratio. So as that continues to drop, dividends will go up once we hit the next threshold, which is 20%. So we end the quarter at around 24% net LTV, and as I said, once we hit 20 or below, the dividend will go to 90%. Strong quarter, and more importantly, I would say a second quarter that has started stronger than the quarter we just went out of. So I think overall, I mean, there's no doubt that the product tanker market in general over the last few years now has shown consistent strength and continues to show a very high level of utilization of the ships that we employ.
And perhaps, Michael, just a few words on the Red Sea and all these disruptions that you see in the market. Perhaps it's good to elaborate a bit on that.
Yeah, so So we and most of the peers that we have are not transiting through the Red Sea because of all the disturbance that's been, particularly from the side of the Houthis attacking commercial ships. It doesn't mean, however, that all ships are not going through. There are still ships that are going through the Red Sea for various reasons. So it's not like 100% of the fleet that's not going, but it has for sure given us extra ton mile, which means that the ships are sailing longer with the same cargo, which by definition will always be good for freight markets in general. And the way things are at the moment, at least, it's not very likely that this will return to normal any near soon. And we certainly have no intention of sending our ships off through this area as long as there is a risk, as there is today, that you're going to get hit or targeted for various reasons that are difficult to safeguard yourself against beforehand.
And perhaps just, I know that you have a lot of dividend investors in your stock, so perhaps just a few more words on the dividend. And this is record high dividends as far as I remember. And your new policy, maybe you can just restate that.
Yeah, so I think because shipping traditionally is a cyclical business, as we know, I think that in general terms, when you've been through a growth period, you always, or should be at least, focused on making sure you have control of your debt side. So for us, it's been a matter of trying to tie up dividend with the reduction of debt. We don't want to go down to zero debt. We don't want to go down to levels that are too low. We think that an efficient capital structure, particularly in a business like ours, where we have heavy and expensive assets, you do need to have an element of debt in it. So we look very much at the current net LTV, but we also do compare it to mid-cycle. So we make sure that if things at some point changes, we know that we are still in what we call a responsible place in terms of our net LTV towards various market levels. But at the moment, because we grew so much back in 21 before the market actually came, we don't have any upcoming capex of any significance. We're not in the market to buy a huge amount of new builds, etc. Our view is that at the moment it's really more about harvesting on the scale that we have. Hence why we have introduced the dividend policy that we have.
Yeah, and I remember from previous sessions like this, there's been always questions about share buybacks and the potential, and you have not completely ruled it out as far as I remember. But so far this has been your policy.
Yes, exactly. And I'm not gonna argue one or the other, right? But people have different reasons why they do things. I mean, of course, if you're trading at a steep discount to NAV, obviously the share buybacks will make sense. And so we do monitor that. We do debate it. But you're right. I mean, for the time being, the real focus is actually on the dividend side, and particularly also now that we're trading where we're trading.
Cool. But and please ask your questions. I'll take them one by one, and most probably in the end I'll take more than this. Is there anything in this one with the operating summary and the fleet coverage that you think is out of? I can't see anything that's out of the ordinary, to be honest.
No, there isn't really. I mean, I think we're still, as a company, we're still in a very good position on the cost side. So when we look at the comparison for our cost, which is the operating expenses, but also the SG&A for running the business, the offices, etc., we are still by far the cheapest platform out there. And, we are at least $1,000 per day lower than the next competition in terms of cost, overall cost per ship per day. So, I feel we have a good cost structure. I think going forward, as I mentioned, Q2 looks to be an even stronger quarter already now. So I think, we're in for a very interesting year so far. So nothing really more to add on it. I mean, I think maybe just one thing is we are looking at some of our oldest ships in the fleet. So, people always ask about what's going to happen to your fleet in general. Well, we do have ships that are built still in 2008, 2009, and we are looking, if prices are right, to offload a few of those. But it's nothing significant. It's just what I would call normal housekeeping, making sure that your fleet is always up to date and as modern as possible.
Yeah, and just if for those who are not normally familiar with it, that there's a big differences between the Q2, Q4. I'm in the right-hand corner now about your coverage rates for the rest of the year. And I guess it all relates to the LR2 is a very small segment for you.
Correct. Absolutely correct. And with time charter out. Yeah, that's right.
Yeah. Okay, so no reason to be suspicious on that one.
No.
Cool. Then I think let's go into this one, because that's the earnings scenarios, and that will most probably be very interesting to all the investors that is attending. So maybe you can just briefly explain what you're trying to achieve with this slide.
Yeah, so we're basically just trying to calibrate a little bit, you know, the various, if you like, the various rate scenarios and estimates we see outside in the world, and compared to what we're seeing ourselves. So if you look at the left side, this is the analyst consensus of where we will be for this year, which is a full year net income of 800 million. If we look at the Q2 covered rates and we extend those to the rest of the year, we'd get to 950. And if we look at what we already have covered through Q2 and Q4 and use that number, we'll end up at 870 for net profit. So we're just trying to show the different levels of estimates versus where we will end up. And you know, I think it's interesting in the sense that you know, looking at our market cap and look at where we are on the earnings, even in a negative case, you know, it's obviously still very, very high earnings and very, very low multiples when you compare it to what the value of the company is as of today.
Yeah, and perhaps I can just ask about that, Michael, because as I said, the market cap of your company is now, let's say, 4.2 billion US. You're making not a billion, but let's assume that's let's say 800 or 900. Then it's 4.5-5 times earnings. So what do you think can change that? I know it's a very unfair question, but what do you think can change that multiple in the market? Because somehow the market doesn't believe that this is sustainable. That's my opinion, of course.
Yeah, I mean, I do think that at least that's what we hear, and you know, in a way you have to recognize is that looking at historically of our business, it has been very cyclical, and I think most of the cycles we've been through has not been super long. So there's no doubt that when people talk multiples, they probably take a step down in terms of average rates and earnings over a period of time. I think that we have advocated for quite a while that looking at the oil and tanker sector in general, there has been an underinvestment, both on the supply side of oil in general, but also on the shipping side in terms of amount of vessels versus demand. And I think this in a way creates a very interesting combination that on one hand, you can see that you need more ships. The fleet is getting, we get to it in a minute, the fleet is getting older and older. But you know, as far as we can see, there is nothing that indicates that you are entering a very cyclical scenario again. Sure, you'll have swings up and down in terms of earnings, but in general terms, I think we believe we're in a fundamental long time for high earnings on tanker companies in general.
Cool. Let's continue, and this was a very big day for you, I guess, with the dual listing and the listing in New York Stock Exchange. I think that the real question here is, first of all, what has happened since? What is your first impressions of being listed in the US?
No, I think that it's been, you know, for us, it's been a good next step, which we actually have been looking at for quite a while, because basically we wanted to tap into a broader investor base in the US. And we can see now, you know, in terms of investors we talk to, approaches from different analysts, etc., that there is certainly an increased interest. We could see it also in the liquidity is beginning to pick up. It'll probably take still a bit of time before we get the full effect of having the dual listing. But what we do think is important is we are a US dollar business, and it would make sense to have a US dollar share price that then gets converted to the Norwegian kroner instead of just having a Norwegian kroner share price alone in a US dollar business. So in a way, you know, we have an expectation that we will become US dollar priced on the shares, and then the NOK will be a conversion. That would be the intention and hope from our side.
And as far as I remember, around the 9th of April, the stock price was 75, 76 or something like that. I haven't looked it up. And now we are close to 90. Do you attribute that to the listing?
I think there's an element of it for sure. Yeah, I do think so. And, you know, I do think there's an element of that. And I also do think there's probably also an element of the fact that people can see that dividend policy going up, you know, there's good visibility. Yeah. There's nothing that indicates the market should go down. So even in the dividend yield alone, you know, I think that's probably had a strong effect as well.
Okay. And the volume, it's fair to say that the volume has actually increased.
Yeah.
And from the slide, it's around 15% that is now traded in the US.
Yeah.
Cool. Very interesting. Very few have done this, Michael, so that's interesting. Let's continue into the industry. I think there's a lot of questions about this, and I don't know, is there any, I think we should go to slide 19, because that is perhaps where we will end up with the order book. There's many questions about this, and especially the order book has picked up in recent in months. Maybe you can share your comments about the order book as you see it right now.
Yeah, so it's true. Yeah, the order book has picked up, which I mean, I think in some form and shape, we all expected that eventually it would. We have to remember, though, it's spread out over many years, right? It's spread out now, including 2027. And I think even yesterday I saw that the first ship for delivery in 2028 has been contracted. So an order book of 13 to 14%, but it's spread out not as it normally is on 2.5 years, but actually 4 to 5 years now, or 4 years at least. So I think that's that in itself is for us not a concern at all, because as you see on the left side of the product tanker age profile chart, we have a significant amount of ships that are above 20 years already. And in a demand scenario that is still going up, I mean, this year, OPEC, I think, estimated another 2.2 million barrels per day increase. Next year, 1.23% up. I mean, there's no doubt that if we reduce the tanker fleet, that in itself is a strong signal for an underlying good market. So that's one side of it. I think what one should also remember on this order book, and I know this gets a bit technical, but if you look at the order book that is described on the right side, you will notice that the blue colors reflect the LR2 ships, and almost half of the order book are LR2 ships, which by definition and historically, 30% of these always ending up in the dirty trade, i.e. not in the product tanker market. So if this has been an order book just with medium range tankers, it would be a different story, because they can basically trade and replace everything. But LR2s cannot replace an MR ship. So I think it's important to understand that it's not like for like percentage-wise and what goes out of the market. You're not going to see LR2 ships in a way balance out the older ships that we lose, for instance, on MRs. And that's due to flexibility, because the ships are too big to participate in that trade.
So can you just take a moment to, because I also saw that news about ordering for 28, and for me, that's 4 years ahead.
Yeah.
What does that tell you about the market participation from yours, I mean, ship owner side, that you order ships that is coming in 4 years or prices now? I just think that's very interesting, because it's a very long side.
Yeah, and I think it's very unusual that you see people doing that, because on one side, I think the reason why the order book has not gone more crazy, if you like, going out there is, of course, that if you get a ship delivery in 2028, I mean, that ship technically has a lifetime profile that takes you well beyond 2050, right? Where we're all supposed to reach a net zero. Sure. So that means if you are ordering ships that don't have the capability of burning a renewable fuel, that in itself is a bit of a gamble, we feel, towards residual value. So that's one side of it, and you have no way of covering your cost. You cannot charter out or secure earnings for a vessel that delivers in 2028. That's almost impossible. So you're taking a risk around the spot market by doing it. So I mean, I'm for sure. I mean, I think there is no way you're going to see an order book accelerate in 2028 on pure speculative basis. I don't think so. But it's mainly because of the residual risk. When do these ships out in the future in 2040, when do they suddenly become subject to the fact that there's a limited to their lifetime, and therefore values will drop? That's the reason why I think a lot of people are holding back from that.
Yeah, my perspective on this, Michael, and maybe you can comment, is that you have a ship owner that now orders ship in 4 years' time, and the market is trading Hafnia shares on 5 times earnings. That there's something wrong with this. Either the market is wrong or the ship owner is completely wrong. That was just my initial thought on this.
Yeah, or in a way you can say, or both are right in the sense that, we don't think there's any significant risk if you look 10 years out, for instance. I mean, we do think that the demand side versus the supply looks super interesting. And even with the end of wars, you're still going to have a very healthy market. So when you buy a ship, though, it's not about the next 10 years. It's more about the price you pay and the time you can run it, right? And I think that the 10 years out, 2035, etc., and up to 2040, I'm sure that there'll be a strong need for product tankers in general. But the thing is, if you buy a ship, what do you then do? Do you change the lifetime cycle to 15 years? Probably, or 20 years, but 25, I don't think you can. So it's more about the people that order ships in 28 now, most likely will have to earn $26,000, $27,000 per day with a reduced lifetime in order to break even. But that's still not a bad business if you are, as we are today, well above 30, right? So I can only assume that's the confidence that goes into that calculation.
Yeah, okay, fair. Can we take some questions? Because there are quite a few questions here. And
Sure.
starting with the Russian shadow fleet. We've had that debate sometimes, but maybe you can comment on your view on the shadow fleet from Russia.
Yes, I mean, it's gone up in general, and I think as far as tankers are concerned, we're now well above 700 tankers that is trading within that. We don't see it increasing, so I think as far as we're concerned, that fleet has now in a way plateaued in terms of where demand is. So the only way it would increase is if some ships kind of in a way drop off because they become way too old or bad quality. I think we have challenges around that for sure, right? And the challenges are that a lot of them are older vessels. A lot of them are managed by technical managers that are, for obvious reasons, trying to, if you like, hide from the public regulation. So, my biggest concern around that fleet is actually that we're going to have some serious issues with oil spills, ships that are not insured. You can't get hold of the owners because they are put in different structures. So it certainly gives me concern about the quality of it. But I'm not concerned about that fleet coming back to the overall market.
Okay.
I think most of these ships will run this business out for as long as it lasts, and then they will basically disappear or find places that are far away from the normal global markets.
Cool. Then there's some questions about the energy optimization of the ships and your fleet.
Yep.
It's a very general question, but of course it has to do with the CO2 emissions and stuff like that. But maybe you can make a general point about your view on this.
So we're putting a lot of obviously energy devices on, right? And as many others will do as much as you can. And just to give a kind of a rough example, if you have a brand new ship that comes out and you basically load up with the energy devices that we have and know today as much as we can, you can probably take off from day one about 17% of your fuel consumption. Now that number deteriorates as you go along because things will happen, the vessel's paint will fall off a bit, etc. But that's kind of where you start, and you probably end with 7.5% once you go into the next dry dock cycle 2.5 years later, just to give an impression. So that's really, those are the key elements. I think what we are trying to operate a lot more in is really to make sure that your actual operation, how you run the ships, how you time arrivals right, all these small things now are the ones that come into play. Once you make the investments on the ships, it's really more about trying to understand the data and work more particularly around how you operate ships, where maybe before things we go up a bit, we go down a bit in speed. I mean, now it's become a science in itself to optimize precisely on everything you do. But we are ahead of the curve in terms of complying with the 2030 IMO regulations. So we expect already to comply with those savings 2 years ahead in 2028.
Cool. Then there's a question about this super cycle, or how you should talk about this within tankers, because obviously you had some benefits of some macro events that has helped out in terms of rates. Do you see any risk of some macro events that can make this collapse?
Yeah, we do. I mean, I think from a macro point of view, well, there are two, I guess. I mean, one is China. And yes, we do think that if for some reason China falls out with the rest of the world, particularly the US, and you get sanctions around it, that will cause issues. I mean, 30% of the shipping finance today comes out of China, and China's financial institutions. So if any sanctions were to happen, that would have a big effect of debt being pulled back, etc. So that's one part of it. I think the other one is close of Hormuz Strait. If the Hormuz Strait up to the Arabian Gulf for some reason gets closed by Iran, and that in itself, of course, will prevent a lot of oil coming out. I personally don't think that's likely, particularly because in previous crises over previous years, everybody had an interest in getting the oil to flow in and out, and all you did is then really had convoys that went up and down and picked up oil. But technically, if that happened, that would also be a negative effect initially for the tanker market.
And perhaps a final question on the fleet, and that is this: can you actually extend the current vessels that is getting old and above threshold? Do you see that? And I guess the question is whether people actually will scrap them or not.
So we initiated already 2 years ago an extension of lifetime of the assets to make sure that we could add another 2.5 years really to ships as they grew older. The thing that everyone should be aware of is that you can't take any ship and add 2.5 years, because if you've left it for like 10, 12 years without doing proper maintenance, there are things you just can't catch up. So that's why you see also us selling some of the ships here and there that maybe don't fit into this. But in general terms, 2.5 years extension makes a lot of sense, and this is all about trying to optimize on the painting of the ships, on making sure that you install features that gives you better flow to the propeller, things like this, steel replenishment. So yes, and that is a significant benefit to the business to do that. I mean, the savings by keeping ships alive in this market, the extra earnings for our business are substantial.
Cool. Thank you, Michael. If there's any more questions, it's about time. What is actually next? I mean, now you're making a lot of money and you are doing record quarters. So, and then you've done this listing in the US. So what is next up for you as CEO, but also for Hafnia?
Well, we still think that there's an element of consolidation needed, right? We think as we go into this new phase of oil and tanker business in general, we still think that there are companies that will need to fall into consolidation. Some companies the investors will want to exit. That will give you another reason for consolidation. So we're still looking out for those things to expand the current, if you like, lifetime of our existing assets and new assets. So that's one part. But we also do have a few projects that are more long-term that involves transportation of renewables, ammonia, blue methanol. So we are beginning to think about transition, although they are a few years out, to look for products and set up a structure that means that Hafnia can both benefit from the current business, but also has a view on, in the future, 5 and 10 years out, we need to think about how we slowly but surely transform into a company that will also do other kinds of renewable transportation.
With those remarks, Michael, I think I'll close this one. Thank you very much for participating, both you, but also the participants, and thank you for your questions. If you have any more questions, write us up or send us an email, and then we'll get in touch. Thank you very much, Michael.
Thank you.